Chapter 21. Options. Options give you the right, but not the obligation, to buy or sell an underlying security. You pay an option premium for the right to trade an asset at a previously agreed upon price by a specified date. You can use options to hedge against risk when you own an underlying position, or trade calls and puts independently for potential profits. Calls and puts simply stand as buy or sell options traded similarly to futures contracts. Call options give you the right to purchase an underlying asset by a specified date at the strike price. When you buy calls or puts, your initial investment is non-refundable. An option premium will cost more if the strike price is closer to the spot price. You will also pay more for options with later expiration dates, since the underlying asset has more time to reach the strike price. Lastly, the cost to buy an option may increase as the volatility of the underlying asset increases. Put options give you the right to sell an underlying asset by a specified date at the strike price. Calls, buy, and puts, sell, are executed only when you tell your broker to execute a trade. There's often an exchange fee to exercise an option, but the only other cost in options trading is the premium price. You can control an underlying asset to a limited extent without actually owning it. When you execute a call option, you want to buy the asset once prices rise above the spot price so that you can sell them for higher prices in the open market. When you execute a put option, you want to sell the asset at the spot price when you can buy the asset at a lower market value. When purchasing a stock option, you pay a premium to control the right to buy or sell an underlying stock during the contract period. By default, stock options encompass 100 shares of any given company. Some other options types include ETF options, index options, and options on futures. By paying an option premium, the most you risk on your bet about the underlying stock is the premium price. In a call, your option contract expires worthless if the price never reaches above the spot price. In a put, your option contract expires worthless if the price never drops below the spot price. Options are leveraged instruments that offer amplified gains. You risk absolutely everything you bet when you buy an options contract. We will look at trading options alone soon, but first let's explore how you can use them to protect unrealized gains and draw cash flow out of existing investments. A covered call strategy assumes you own a stock for a long-term investment. If you're confident about the underlying company, you do not think a stock will rise that much in the short term, you can sell a call option to the marketplace at a strike price around 10 or 15% above the current stock price, whatever price seems reasonable and unlikely to occur to you. Since someone will pay you a premium to buy the call option you sell, you can generate cash from your long-term positions as long as you correctly predict price movements. The best case scenario in a covered call is that your stock stays flat. Here, your underlying position loses no value, and you get to keep the premium from the unexercised option. If the stock price falls, the premium paid for the call option acts as a hedge that pays you for some of the losses in your underlying stock. In both of these scenarios, you'll make extra cash flow by taking on the risk to sell a call option to the marketplace. By using technical analysis, which we will explore in part 2, you can minimize this risk. In a worst-case covered call scenario, the stock price increases above the strike price. The option buyer exercises the call option where they see fit before the expiration date to make a profit while you miss out on gains above the strike price. Option exercise time frame depend on option types. We will look at different types soon. You still profit from the stock run up in option premium, but you have to sell your shares under market value to the option buyer who paid for the right to purchase the shares at strike price. You can also use a protective put to protect your long holdings against downturns. If you think prices will increase, you can protect against an unlucky short-term downtrend through a put option while still owning the stock. With this put, you will still be able to reap rewards if your stock appreciates or pays dividends, but you will also have a guaranteed selling price at the option strike price if the market turns down. You'll pay an option premium no matter how the stock moves, presumably out of existing profits. If the stock goes up as you intend, then your option will go unexecuted and you will only lose the premium paid from your newfound profits. This strategy limits your maximum loss to the strike price you are guaranteed to sell at in the given time frame, since you can execute your option if prices tumble below the strike price. However, unlike a stop loss, you can keep the position open until the option expires if you want, giving the stock time to recover and move towards new highs without forcing you to rise, losing any more money during the option period. Assuming American option, see below. Remember the two types of options as you trade covered calls: protective puts and standalone options, American and European. American options can be executed at any time before the expiration date, whereas European options cannot be executed until the expiration date. American options give you the most trading flexibility, and your broker will usually execute your options for your on expiration date if the contract is in the money. Most options are traded before expiration to obtain optimal profits by using technical analysis to find maximum and minimum prices. See part 2. Here are two charts to show you your potential upside and downside with a covered call and protective put, assuming either option has underlying long holdings. Sell call at A. And we see a chart and we see that our upside is capped, but our downside has a little bit of a buffer. The covered call forces you to sell your shares for a profit if prices increase, but you also get cash from the marketplace for incurring this risk. For long-term stocks that do not pay dividends, you can use your technical analysis skills from part 2 to identify downward trending periods and sell calls to generate investment income from your holdings. Then we see buy put at A, and our downside is capped, but our upside is not. The protective put limits your downside, but you need not worry about actually exiting your position if prices do increase. Rather, you can execute your option when market timing optimizes your profit while you decide whether to continue holding the underlying stock for the long term. Here's an example of a live option chain for Facebook Inc. expiring on December 28, 2018. Notice the bars along the edge of the option chain to emphasize the puts and calls in the money. The puts show are live options contracts to sell Facebook, while calls are options to buy the stock in the future. Now we see the top of the chain, and it's a straddle showcase of all the options with a median stripe, and then the rest of the chain with the strike in the middle and puts on the right, calls on the left. The chain shows open trades for December 28, 2018, expiration date for Facebook. The last price represents how much you would pay per share for the given option premium at market, or how much you can sell your contract for to take early profits. Because each contract represents 100 shares, the total options premium for one lot is the last price times 100 shares, where the last price represents the last given premium paid to a contract seller at a given strike price at expiration date. Given the last prices from the option chain, a $130 Facebook call buy would cost $1.55 times 100 shares equals $155, while a $120 Facebook put sell would cost $2 times 100 shares equals $200. All contracts expiring December 28, 2018. If you bought a call and Facebook increased to say $140 in 1 month contract, you'd profit $140 market minus $130 call minus $100.55 premium times 100 equals $845 premium. Inversely, if you bought the put and Facebook decreased to $110 in 1 month contract, you'd profit $120 put minus $110 market minus $2 premium times 100 shares equals $800 per contract, given the above market prices shown in the options chain. Note that disproportionate put and call premiums may indicate market sentiment towards the stock, as you pay more to bet in one favorable direction. However, try to go against the masses and blaze your own path, as the majority, except for overall index performance, is often wrong. The open interest represents the number of open contracts at any given strike price. As you near the spot price, open interest and subsequent liquidity generally increase, but this volume still dwindles compared to actual stock trading volume. Because of this, options generate generally have much higher spreads than their underlying stock when you try to exit a position before expiration by purchasing a contract to cancel out your position, just as with closing futures contracts before expiration. Look for high open interest to maximize liquidity, especially as you trade options on lower volume volatile stocks. With your broker and subsequent options exchange, you will trade options using the following code pattern, similar to futures contracts. Option symbol equals base symbol plus expiration month code plus strike price code, where base symbol equals the asset representation up to 3 letters. Usually the stock ticker if it fits. Simply look at the asset to find its symbol if its ticker is over 3 letters. And monthly call codes from January to December are A, B, C, D, E, F, G, H, I, J, K, L, where monthly put codes are M, N, O, P, Q, R, S, T, U, V, W, X. Expiration occurs on the 3rd Friday of any given month. Therefore, our Facebook Inc. example contract order would look like FBX price put or FBL price for call. Monthly or yearly trading is the most common option time frame for swing and long-term trades, since this gives the underlying asset ample time to reach the strike price. There are other more active time frames, but commonplace stock trades often offer more convenient over daily or weekly options due to faster execution and exact prices. Options can only be bought or sold along standardized price intervals based on the spot price of the underlying asset. Price codes differ from security to security based on the asset's price interval and how your broker routes the order. Look at your broker's platform and see how they handle order entry and execution. Often you can simply enter a strike price to trade at along a secondary market spread. Since naming schemes and order entry can be confusing, many options chains and brokers display simplified order metrics. For our Facebook Inc. example, Yahoo Finance simply displays a $130 strike price call option expiring on January 25, 2019 as FB 190125C00130,000. Space is added. This naming makes it easier to analyze the current market, streamlining your research to help you make better investment choices. Remember that option premium prices come from 2 factors, time value and inherent value. The total premium cost to buy an option, also the price you can sell your options at, combines the two as shown below. Options value, premium price, equals inherent value plus time value. Inherent value comes from the difference between the strike price and the spot price. If an option is out of the money, the inherent value is 0. If the entire premium cost is in time value, and the entire premium cost is in time value. If an option is in the money, simply calculate its value compared to the spot price. For example, one $120 put contract for a $100 stock is worth $200 minus premium paid. The remaining market value of the premium price is the option's time value. Time value decreases as the option nears expiration according to the following graph, as there's less time for stock to reach the strike price. And then we see option time value is contracts near expiration, and as it closes down to 0 days until expiration, the relative time value geometrically decreases depending on the underlying asset. So, option value decays as price stays the same while nearing expiration. Additionally, higher implied volatility increases relative time value since a stock can deviate more towards a strike price. Your broker usually requires you to have a margin account to trade options. A margin account will also help you trade stocks more efficiently by bypassing the clearing business days during which a transaction settle and you cannot trade with the cash proceeds. Once you can trade puts and calls alone, you can use them to generate high returns since each contract controls 100 shares. Any small price movement multiplied by hundreds of shares brings high potential profits with high risk since you lose the entire premium if your option expires out of the money. The only strategy with puts and calls alone is to use technical analysis to predict where stock price will move. With that said, let's explore some complex options trades with lower risk or generate cash flows with costlier setups. In a straddle, you buy a put a call and put option with different strike prices slightly apart from the current price, out of the money. This strategy makes money when there's a large movement in the underlying stock in either direction, as shown in the chart below. Then we see a long straddle, and you have a capped loss, and then as it goes away from the strike price on either side of the price movement, you have increased profits. In this case, you'll only lose money if prices trail sideways until expiration date, as long as your strike price are close to the spot price. This trade also exposes you to profit from both sides of price movement while paying an option premium. A great strategy for volatile stocks or perhaps a more established companies with a high tension earnings report. In a straddle, you buy a put and a call at the same strike price, very close to the current price at the money. The straddle costs more to exercise since options near the spot price tend to be more expensive, but it also gives you a better profit guarantee as long as the price moves in any given direction to cover the premiums paid, as shown in chart below. Profit or loss in our long straddle, and we see a greater initial loss but also a quicker move to profit. If you're clueless about where an asset might go, say perhaps a difficult to time market tracking index fund, then straddles and straggles and straddles can help you profit off underlying volatility with defined risk. A maximum loss is net premiums paid plus commissions paid, which only occurs when the spot price expires at the strike price. In an iron condor, you buy two options and sell two more in hopes that the stock will remain stable. As long as the stock does not move into the strike price of the options you sell, you leave your purchased options unused and keep the premiums from the options you sold. If the prices do pass an option you sell, your two you bought will limit your downside. So, for a $20 stock, you can buy a put at $10, sets a maximum loss if prices decrease, sell a put at $15 to generate cash, sell a call at $25 to generate cash, and buy a call at $30 to set a maximum loss, all trades at the same expiration date. If a stock is especially volatile, you can sell your two options further apart from the spot price at a cheaper premium to decrease the risk the prices hit your strike price. However, try to keep the differences between your two calls and two puts the same to minimize overall risk and create the following potential profit chart. Then we see an initial profit as the prices stay towards the original price, and then a huge loss towards expiration if it deviates away. So that's just because you can sell it for more cash as you near the strike price where the options will have a higher inherent value. To increase upside and risk, you can refrain from buying the put and call as moderately costly insurance policies. By only selling a put at A and selling a call at B, you get the following chart, which has an increased initial profit but an unlimited loss. Since the standard iron condor requires 4 trades, try utilizing a low commission broker as we will explore in chapter 37. Note that since your profit comes from the options you sell, you will usually have to wait until expiration to keep the money you collect, and any variation outside of your price range before the expiration date could quickly create a loss. In a butterfly spread, you can also use 4 options to bet prices will remain stable. For example, in a butterfly spread for a $40 stock, you can buy an in-the-money call at $30, builds capital base for the setup, sell 2 calls at $40, generates cash, and buy 1 call at $50, sets a max loss of price increases. All trades at the same expiration date. With this strategy, you will reach peak profitability when the options sold expire at the price you sold them at, and a price above the in-the-money call you bought them and can now sell, profit chart shown below. Note that the in-the-money call you buy loses some of its value over the trading period, say 1 month, since the value of an order depends on how much time it has till expiration, given less time to fluctuate above or below the execution price. Then we see a long butterfly, very high profit at the strike price if the stock price is there, but then you'll have larger losses as it moves away. As with the rest of these multi-leg setups, your maximum loss comes from the option premiums you pay. The low profitability area of this setup in particular makes it risky but rewarding when you're confident about future price action and balance the position well in your overall portfolio through diversification, as we'll explore in Chapter 35. Alternatively, you can sell a call and put at strike price A to form the following chart without downside protection if your certain prices will remain flat. These strategies work best when the options chain shows low implied volatility, a measurement you can also find from Bollinger Bands, which we will explore in Chapter 32. And then we see this one has a higher initial peak and then just no downside protection. There are over 50 or so combinations of call and put options patterns used by active traders. We've gone through the most unique strategies that apply specific options-only scenarios. Many other strategies simply mimic positions you can take with a simple stock order. While options provide leveraged returns, actual stock trading will keep your gains consistent and predictable in the end. Nonetheless, consider trading options as part of your overall trading strategy for swing trading and long-term investing.